Americans are buying stocks thinking everything's fine, and the foreigners are going, you guys are screwed, we're buying gold. If you create a debt bubble, you only have two choices. You either pay it back or it's gonna blow up. And we're not gonna pay it back, so it's gonna blow up. That's what's happening right now. We're in the process of the debt bubble blowing up. We can't afford our debt anymore. So the creditors are basically rug pulling us right now, but nobody's paying attention. Who are our creditors? Our creditors are foreigners. They buy the debt. And if the creditors go, I don't want your stinking debt anymore, then that's it. It's game.
You're watching Silver News Daily. Subscribe for more.
They've already pulled the rug, and you didn't even feel it. While Americans keep piling their savings into overvalued tech stocks and meme ETFs, the real money is quietly escaping the system. Foreign central banks, once the largest buyers of U.S. debt, are dumping treasuries in bulk, cashing out of the dollar and racing into gold and silver. The dollar isn't collapsing next year or next month. It's collapsing right now. And the average investor is completely blind to it. Just weeks ago, silver closed at its highest quarterly level in history, brushing up against $49 an ounce, up over 65% since the start of the year. Gold blasted through $5,000 before pulling back, and that's just the beginning. These aren't normal price moves. This is what it looks like when a currency system starts to fracture. But while global players reposition into real assets, Americans are stuck in fantasy land, distracted, over-leveraged, and asleep at the wheel. And that's exactly what the architects of this crisis are counting on. Because once fear sets in and the herd panics into precious metals, it's already too late. The paper markets break, premiums explode, and physical supply vanishes. When that happens, $150 silver won't be a headline. It'll be the new baseline. So how did we get here? And why is silver set to become the ultimate beneficiary of this global financial reset? Let's unpack it.
He's like, okay, well then at least I'll try to raise some revenue through tariffs, which is an act of desperation, and it's negative on the economy. Tariffs are not positive. They're not. They're net negative because who pays? It's basically a tax. Someone's got to pay it. It's not a free pass. Someone's going to, that money's going to the government. And how is the money collecting it, right? And so Triffin's dilemma is playing itself out. And Triffin's dilemma, and just to define it really fast, was just this idea that if you have, he basically said the U.S. is screwed because you guys have the reserve currency. And if you have the reserve currency, that's not good. That's bad because what it does is it ends up hollowing out your economy because you can't compete. It's basically all about the transfer of payments and interest rates and in your currency. And you basically, there's nothing you can do about it because your currency is going to be the strongest currency because you are the reserve currency. That's it in a nutshell. You're going to have the strongest currency because everybody needs to buy it. You got this big advantage. It appears that you have an advantage over the rest of the world, but in actuality, it's a net negative because it hollows out your economy. It's like a cancer. It's like you're eating something that's just going to kill you. It's just, you're just playing with fire. And that's what the U.S. has been doing since the 1980s. We've been playing with fire. And now it's caught up with us. And that's why gold is at $3,800 and keeps going higher. Because gold's going, you guys are screwed. There's nothing you can do to fix this. There's only one solution, which von Mises clearly pointed out. He basically said, look, if you create a debt bubble, you only have two choices. You either pay it back or it's going to blow up. And we're not going to pay it back, so it's going to blow up. And that's what's happening right now. We're in the process of the debt bubble blowing up, and we can't afford our debt anymore. So the creditors are basically rug pulling us right now, but nobody's paying attention. Who are our creditors? Our creditors are foreigners. They buy the debt. And if the creditors go, I don't want your stinking debt anymore, then that's it. It's game over.
The United States has built its empire on an ever-expanding mountain of debt. And now, that foundation is starting to crack. For decades, politicians kicked the can down the road, borrowing trillions to fund wars, welfare, and Wall Street bailouts. Each crisis was met with more debt, more stimulus, more quantitative easing. And while the world tolerated it for years, the math never added up. In 2025 alone, the U.S. ran a fiscal deficit of over $2.5 trillion, adding to a total national debt that now exceeds $40 trillion. That's more than 150% of GDP and still climbing. This is the debt trap. The U.S. has reached a point where it must borrow more just to pay interest on what it already owes. That means higher issuance of Treasury bonds, lower confidence in repayment, and more pressure on the Federal Reserve to monetize the debt. But here's the catch. The more the Fed prints to keep the game going, the weaker the dollar becomes. And that's where the real problem begins. Enter Triffin's dilemma, a flaw hardwired into the system. As the world's reserve currency, the U.S. must export dollars to support global trade. But doing so means running constant trade and budget deficits, slowly hollowing out the domestic economy in exchange for short-term liquidity. It's a paradox with no exit. Support global demand for dollars or protect the value of the dollar itself? You can't do both forever. And now, after years of abusing this privilege, the world is calling America's bluff. Foreign holders are no longer willing to bankroll U.S. deficits. They see the writing on the wall. A sovereign debt crisis is no longer a tail risk. It's a present reality. The dollar isn't just being devalued, it's being rejected. And as faith in the system collapses, silver is stepping into the spotlight as the monetary alternative the mainstream forgot.
Forward, the debt explosion began. So you had debt explosion number one was in 1980. So Reagan came into office. Our national debt was under $1 trillion. He leaves office and it was 2.7. He just pedal to the metal. And then in 2000, I think the national debt was about 5 or 6 trillion. And today it's 38, 37. And so it's just been going higher and higher and higher. And so since 2000, and this, it's just Triffin's dilemma playing itself out. I mean, once you start living off debt, you're going down a slippery slope. So starting in 2000, we started averaging 8% annual debt increases, 8%. Well, you can't have 8% GDP. There's no way in hell, right? So we've been living on 8% annual debt expansion. Now, you have to ask yourself why. Why do we need 8% annual debt expansion? Well, guess why? It's because we're not generating any wealth. So we need the debt to stimulate the economy to create 2 to 3% GDP. So we're living on debt. And that's the voodoo economics that Bush was talking about, that everybody ignored. And to this day, they ignore it. Nobody's really talking about the debt bubble except for people like me, the alt media, the people on the podcast. But you don't hear about the debt bubble. Like I watch CNBC's halftime show and Closing Bell. You never hear the word debt bubble. Maybe they might mention the budget deficit once a month, but they never mention debt bubble or debt crisis. That might come up maybe on the Closing Bell by a few analysts, but by and large, it's kind of ignored by most of the analysts. And that's the reason why gold's going up, and that's the reason it's going to continue going up, because Triffin's dilemma is playing out, and there's nothing at a certain point. There's nothing you can do to stop it. You get in a doom loop. Once your debt gets to a certain level, you get into a doom loop. And no matter what you do, it just gets worse. So right now, for instance, the perfect example was the big, beautiful bill, right? There's no way in hell Trump wanted to do that bill. He just had no choice. If it was his choice, he would have balanced the budget, right? He would have balanced the budget, but he couldn't. He had to basically have a $2 trillion deficit, because if he didn't, the economy would go into recession. It's called fiscal dominance. You're locked in to spending money, because if you don't spend money, then the economy crashes. So it's like,
The global exodus from U.S. treasuries has begun, and it's accelerating fast. For years, foreign central banks were the safety net, scooping up American debt as a guaranteed return. But that illusion has shattered. In 2025 alone, countries like China, Japan, and even longtime allies like Saudi Arabia slashed their holdings of U.S. treasuries, with total foreign ownership falling by over $1.2 trillion. That's not a portfolio adjustment. It's a vote of no confidence in the entire U.S. financial system. And they're not just selling. They're rotating. That capital is flowing directly into physical gold, silver, and other tangible assets. China's central bank added over 300 tons of gold in just 9 months, while Russia has moved aggressively into bullion and away from dollar-linked reserves. Even smaller nations like Turkey and Brazil are following suit, dumping treasuries and building strategic gold stockpiles. Why? Because they see what's coming. A global currency reset that strips the dollar of its dominance and forces a new monetary order. This is what the end of dollar hegemony looks like. Not an overnight crash, but a steady, deliberate retreat from the system. Foreign nations are front-running the collapse, exiting quietly while the door is still open. And it's not just about inflation or interest rates. It's about survival. As the U.S. weaponizes its financial system through sanctions and capital controls, holding dollar-based assets has become a geopolitical liability. The smart money isn't waiting for the alarm bell. They already heard it. And while the world shifts into hard assets, what's happening to silver? It's being positioned as gold's more volatile twin, a sleeper asset with far more upside once the dominoes fall. Because when confidence in fiat evaporates, investors don't ask questions. They just want something real. And silver, with its dual role as both an industrial and monetary metal, is becoming the go-to play for those who can see the storm before it hits.
This bounce that we had today, where silver was up, I don't know, it was up $2. And gold was up today. I don't know, $50. This is what we've seen over and over again for the last 18 months. Whenever gold has went down, so we were in this range, this tight range. Gold was in this tight range, and it created this flag where it just recently broke out at 3,700. But it was in this tight range of, I think, 3,300 to 3,500. But it was in a tight range for several months in a row. And every time it went to the bottom of that range, it would just turn around and go back up to the top of the range. It was like, go to the bottom, go back to the top. In other words, it was following the stock market. So gold would go down a little bit, but then the stock market would go back up, and the gold would say, oh, you're going up? Okay, I'll come follow you. And then gold would go down, the stock market would go up, and oh, okay, here you go. So gold has been following the stock market up, but outperforming it in a big way. I think stock market's probably up 15% for the year. It was up 13, maybe 14% for the year, somewhere there. I think it's a little above 13. But gold's up 45, 47 for the year. So gold is the leader here, not the stock market. Gold's the leader. And so even though it's following the stock market higher, because the stock market just keeps making all-time highs, gold not only follows it, but it exceeds it in a significant manner. But gold's the leader here. And the reason why I love gold and silver so much is why. I mean, the reason why gold is the leader this year is because Triffin's dilemma is playing out. This is all about Triffin's dilemma. This is the reason why I've been a gold investor for all these years, is that I go back to George Bush Sr. when he called Reagan's economic plan voodoo economics. And he was really a lone voice. When he said that, when he said voodoo economics, nobody else had said that. Nobody else had attacked Reagan. No economist, nobody really attacked him that I was aware of. It was kind of out of left field, but it was spot on. It was absolutely spot on. You can't live on debt. And that's what the U.S. has been trying to do since the 1980s. And now it's become, it really picked up speed after the 1990s in 2001.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
While the dollar bleeds credibility and treasuries lose their luster, gold and silver are being scooped up like lifeboats on a sinking ship. But here's the twist. This isn't just about tradition or safety, it's strategic. Central banks are rebalancing toward hard money assets that can't be printed into oblivion, and this shift isn't just happening behind closed doors. It's showing up in the numbers. Gold reserves held by global central banks have hit a 50-year high, but silver is the real story no one's talking about. Unlike gold, silver has remained vastly underpriced, overlooked, and undervalued. But that's starting to change. COMEX data shows a surge in open interest, signaling heavy institutional activity. Silver ETFs have seen a 15% increase in inflows this year alone, and demand is outpacing supply at a level we haven't seen since the 2011 spike. This isn't a retail-driven mania. This is the groundwork for a massive monetary repricing, and it makes perfect sense. As the global financial system strains under unsustainable debt, central banks are preparing for the next phase, one where fiat confidence collapses and a new standard emerges. Silver is being reevaluated not just as an industrial asset, but as a form of sound money. The 81-to-1 gold-to-silver ratio signals a massive imbalance, and if history is any guide, silver always plays catch-up, with explosive results. The rug pull isn't coming. It's already underway. And while Americans are still chasing paper profits in tech stocks and crypto fads, the world's largest financial players are hoarding real assets. The old system is quietly being dismantled, and silver is being positioned as a cornerstone of what comes next.
That's when we win. We win when we're the only game in town. That's when, basically all the assets are going down. Your house is going down. The stock market is going down. Even bonds are going down. The only thing that's going up is gold and possibly silver and Bitcoin. Those are probably the only assets that are going higher, and everything else is going lower. We're getting close to for that pivot. I've been waiting for that pivot for more than a year, maybe 2 years, waiting for that pivot where the markets go down and gold goes up, that kind of decoupling. So we've had gold and the stock market correlated since March of last year. So 18 months of strong correlation, which is kind of weird. The gold basically took off in February 24, and it just hasn't looked back. I mean, we didn't retest 2,000. We didn't retest 3,000. We did not retest those levels. We have not retested 40. I don't know if we will. I think we will, but we might not. I do think that we're going to get a correction in gold, and when the stock market finally goes down. One point I want to make here is that I don't think that gold and silver are going to correct on their own without the stock market. Everybody's saying, well, these miners, RSIs are through the roof. They have to correct. I'm getting out of here. I'm trading. I'm taking profits. And the gold's been correlated to the stock market. So I don't see gold and silver correcting just because they made these big runs. I think it's going to take the stock market to correct before gold corrects. So if the stock market doesn't correct this month in October, we could easily go above $50 in silver. And that would take us, 75% up for the year. And gold could easily go above 4,000. That would take gold about 50% for the year. And the HUI, 650 or higher before this thing finally does correct. I mean, that's what I would like to see. The higher that we get, the better for us as investors, because then when we correct back down, we have a lot of room for error, if you will. I mean, if the stock market, I wrote today in my Friday night recap that I think that the correction is only going to be 25% for our stocks. So that'd be about a 12% correction in gold. That's kind of like worst case. That's really not much. In 2008, my portfolio went down 70%. And I think the HUI went down 70%. We had a mega crash in the miners in gold and silver in 2008. I'm not expecting that. That's a severe correction. For me, I'm thinking 20 in 2025 is about as deep as we're going to go. And as far as I'm concerned, that's a nothing burger. And the reason why it's a nothing burger is because it's going to be short-lived. If we're in a bull market, and I think we are, in gold and silver and the miners, if you're in a bull market, when you get a correction, it's usually followed by a bounce and a new high. That's what a bull market is. So I'm not really worried about a correction here. As far as I'm concerned, ride the train and buy the dip.
The dollar's decline isn't speculative, it's systemic. And the rug pull, that silent collapse the mainstream refuses to acknowledge, is already unraveling the financial foundation beneath our feet. Look around. Bond yields are spiking, credit markets are seizing up, and liquidity is drying out. The Federal Reserve is caught in a trap of its own making. Tighten too hard, and now they trigger a debt implosion. Ease too soon, and this they accelerate the dollar's death spiral. Either path leads to the same destination, currency debasement. But here's what most investors miss. This isn't just a slow-motion collapse. It's an engineered exit. The largest institutions on the planet are rotating out of fiat, out of digital promises, and into physical metal while there's still time. They're front-running the fear trade. And once the public catches on, once the headlines shift from rate hikes and CPI reports to capital controls and dollar rejection, there will be no turning back. That's when the panic buying begins. And silver? It's quietly building momentum beneath the surface. The price action doesn't lie. Silver broke through the $33 to $35 consolidation range in Q2 and never looked back. It climbed to nearly $49 without a single meaningful retest. That kind of move signals strength, not speculation. It's institutional positioning before retail hysteria. It's what happens when the smartest money on earth starts preparing for a post-dollar world. This is the real currency reset, not some future event, but a process already in motion. And silver, with its unique blend of monetary history, industrial utility, and scarcity, is being revalued in real time. When the rug is finally felt, when panic meets reality, silver won't be reacting. It'll already be gone.
Dollars for the week. Silver closed at $47.88, almost $48. Those are definitely the highest weekly closes ever for you. I mean, cycle high for silver, all-time high for gold. And the HUI at 620. For the year to date, we have gold up 48%. We have silver up 65%. We have the HUI up 114%. So those are some stunning numbers. We're looking at historical stuff here. I mean, 65% movement in 1 year. I mean, and we're not even done yet. Pretty amazing stuff here. But the thing that's amazing is that we still haven't really begun yet because, in my opinion, we still have the most important facet for gold and silver miners is a fear trade. So the only time historically that the miners have done well is when investors didn't really have a choice. They couldn't make money in stocks, so they went to the miners. Best example is the 1930s. Gold stake mining was the number one performer. And then the 1970s, the miners did unbelievably well in the 70s because the stock market did poorly. And then from 2001 to 2011. So historically, the miners do exceedingly well when the stock market is not doing well. Well, guess what? The stock market today closed at a weekly all-time high. So it's like, what the hell's going on here? This is not when gold is supposed to shine. Gold is not supposed to be shining when the stock market is doing well. They're opposites. Gold is a hedge for uncertainty. The stock market, when the stock market is an all-time high, that means there's low uncertainty, right? The VIX is down, 17. It's like there's no fear, there's no unawareness. What the heck is gold doing so high here? So my point is that, yeah, we got the HUI up 100%. We got GDX, up 130%, 140% for the year, probably 130. So we're seeing this unbelievable performance, but believe it or not, it's potentially just starting. I think it is just starting. I think the HUI is going to somewhere between 1,500 and 2,000. So it's at 6,000 right now. So it'll double. I don't think it'll double again after that. But I think it might come close. But my point is we're early innings here still. I'm still waiting patiently for the stock market to stop going higher.
Silver is standing in the middle of a perfect storm, one that's been building quietly for years and is now unleashing all at once. On the surface, its explosive price action might seem like a reaction to inflation or investor demand. But dig deeper, and the foundation is far more powerful. Industrial demand is going vertical, and the supply side simply can't keep up. Let's start with the numbers. Industrial consumption accounts for over 50% of global silver use. And in 2025, that figure is surging. The solar industry alone is projected to consume 250 million ounces this year, up 25% from 2024. Electric vehicles, powered by an unstoppable shift toward decarbonization, are absorbing more silver per unit than ever before. Wiring, battery tech, onboard sensors, you name it. And that's just the beginning. AI infrastructure, data centers, high-efficiency semiconductors, 5G and beyond, is now another key pillar of demand, growing at 10% annually. But here's the issue. The market wasn't prepared. This kind of synchronized, large-scale industrial acceleration is colliding with a stagnant supply base. Mining output is flat. Recycling isn't scaling fast enough. And inventories are being drawn down at a pace that signals one thing: a structural deficit that can't be papered over. That's what makes silver different this time. In past bull markets, investment demand led the way. Now, it's industrial and investment demand together, pulling in the same direction and straining a fragile supply chain. And when you combine that with the macro backdrop, a dollar in decline, a sovereign debt crisis, and institutions racing into real assets, what you get isn't just a price rally. You get a setup for a parabolic move, one that could take silver not just to its all-time high, but well beyond it.
I really don't care what that stock does. I mean, there's literally no emotion. Most days when the stock goes up, the stock market goes up or down, I don't feel it at all. There's absolutely zero emotion because my portfolio is so spread out and so diversified. I talk about it in my book, how you create a foundation of high quality assets at the bottom of it, and you don't over allocate to high risk stocks. And so by me doing that, I've taken all the emotion out of it in my portfolio. What I've done is I've created an edge. So I want to go to bed thinking I got the advantage here. So the reason why I have the advantage is because if you get a good entry price on a mining stock and the price, all you need is the price of gold to go up, you have an edge. Because all I need is the price of gold to go up and I make money. And it's basically a single variable. Now, that single variable doesn't mean that all my stocks are going to go up. It means the majority are going to go up. I don't need them all to win. I only need, 80% to win and 20% to win really, really big. 20% can be, poor performers. It won't hurt me at all. And so that's my edge. And so I created that edge through good stock picking, but allocation is really important. And my book really explains how to do this, how to basically create, an allocated portfolio. And I mainly do it by keeping my allocations low on high risk stocks. And so I'm going to do the same thing when I sell. When you sell, I've already done this for about 15 stocks. I already have exit points on about 15 stocks, and those exit points will grow. And so those exit points, they're already determined. And so I will get an email when those companies hit those exit points. I'll get an email, and there's no emotion there. I get the email, I go sell. And so I'm going to use the same discipline selling as I did buying. Take the emotion out of it. And so that's ironically, it's probably going to be harder to sell than to buy, because when I buy, it's pretty simple. You find a stock you like, and you buy it at your minimum price, or you buy it at your pain level, or you buy it above your pain level because you really like it. It's really simple. Buying is actually really simple for me. It's all based on risk reward. But selling it will probably be.
The chart doesn't lie. Silver has already broken out, and what we're seeing now is just the early phase of a much larger move. In late September 2025, silver closed at $48.68, its highest weekly close in history. Year to date, it's up over 65%. But this isn't your average commodities rally. This is a structural repricing, a shift from suppressed, range-bound price action to a full-blown bull run. Why does that matter? Because silver didn't just break resistance, it obliterated it. For nearly a decade, the $35 level acted as a ceiling. Then in Q2 2025, silver shot through the $33 to $35 range, never looked back, and climbed into the high 40s without a single meaningful pullback. That kind of move tells you something critical. This isn't speculative froth. It's sustained demand, the kind that builds behind the scenes for months before erupting into the open market. Open interest in COMEX silver futures has surged 12% since Q1, showing that institutions are not only buying, they're committing capital long-term. At the same time, silver ETFs are experiencing their strongest inflows since 2010, rising 15% in 2025 alone. And these aren't meme-driven spikes. These are signals of smart money rotating into a market that's finally shaking off decades of price suppression. But here's the kicker. Despite all of this, silver is still undervalued relative to gold. With gold trading above $3,800 and silver at $47.88, the gold-silver ratio sits around 81 to 1. Historically, that ratio compresses dramatically during metals bull runs, often reaching as low as 30 to 1. And if that happens again, with gold at current levels, silver doesn't just hit $50. It rockets toward $125 and beyond. This price action is the warning shot. The breakout has already happened. The confirmation is in. And for those still watching from the sidelines, every day silver holds near all-time highs is another day closer to a full revaluation of the metal the world forgot. Until now.
I don't know yet. I have a lot of possibilities, but until the time comes, until I actually pull the trigger, I'm not sure. One thing will definitely be certain. I will definitely buy physical gold. I mean, that's a kind of a no-brainer because I'll be trying to maintain my capital. I won't be trying to make more money per se. So gold is a really good place to hide, if you will. So that's really the only one for sure. The other one is fiat. I probably buy like 3 different currencies. Like the Swiss franc is definitely one. I might go with the euro. Might go with the Canadian dollar since it's my neighbor. But I'll probably put some money in multiple currencies just because, right? Liquidity or whatever. But as far as other types of assets, I'm not sure yet. I have a bunch of possibilities. I want to go back to the emotion thing, which I think is important. So I've been a very disciplined investor. I take the emotion out of all my stocks because I learned really early on that I'm basically very emotional about it. I learned that through like trying to buy options, and I found that I'm just terrible. Terrible at it because you have to have the right mindset. If you want to find out if you can trade stocks, just do some options. You'll learn real quickly if you're any good at it, if you're a good trader or not. And I found out it's not so much trading, it's the emotions, because once you buy an option, you have to figure out when to sell. It's like, okay, you're in the money now. How long do I go, right? It gets really mind racking. And so do I sell today? Do I sell tomorrow? You wake up every day. Do I sell now? It's a very trying thing, and it requires a lot of your energy. And so I learned very early on that I do really well if I stay under like my pain point. So I found that if I do low allocations, I really don't care how the stock does. So I buy a stock, I have like a minimum level, and then I have like a pain point. And so if I stay in any high risk company, I just stay below my pain point. And if I'm below my pain point,
But price action is only half the story, because beneath silver's breakout lies a supply chain stretched to its breaking point. Despite surging demand from both industry and investors, global silver mine production is flatlining. In 2025, output is projected to remain stuck around 850 million ounces, the same level as last year. And that stagnation isn't accidental, it's structural. Major producers like Mexico and Peru, which account for a huge chunk of global supply, are facing growing headwinds. In Mexico, production fell 5% in 2024 due to labor unrest and sweeping regulatory reforms that spooked foreign investment. In Peru, political instability and environmental scrutiny have delayed key projects, leaving the country's output stagnant for a second straight year. These aren't temporary setbacks. They're symptoms of a deeper problem. The easy silver has already been mined. Ore grades are declining, discovery rates are down, and new projects are taking longer and costing more to bring online. Even recycling, often touted as the safety valve for supply, is falling short, with only an 8% uptick in 2024, nowhere near enough to close the growing deficit. That deficit is now estimated at 200 million ounces for 2025, and it's only expected to widen. This imbalance between flat supply and explosive demand isn't a forecast, it's a present-day reality. And as the market begins to internalize just how tight things have become, the repricing won't just be vertical, it'll be violent. This is why silver miners are quietly becoming one of the most leveraged plays in the entire market. When physical shortages meet institutional demand and paper claims start to collapse under the weight of real-world constraints, mining equities are set to explode. But the window to position before that re-rating is closing fast. Because once the world sees what's happening beneath the surface, the scramble for silver won't start. It'll already be over.
At the back of gold in a big way. I mean, we're not even a recession in it yet. The bond market really hasn't even become fragile yet. I mean, the strength of gold, the real strength of gold really hasn't even kicked in yet. The strength of gold is when you realize that a reset's inevitable. We're not there yet. So the strength of gold is ahead of us. So let's wait. The way I've been saying is let's wait to get to $4,500 gold. It's a nice little round number. And let's reassess then. But my expectation is that I'm using $5,000 gold right now to value miners, and I think it's way too conservative. I think 5,500. I think 125 silver and $5,500 gold is probably a better number. And so I'm going to have to change my prices pretty soon on my website. I think those are better numbers. I think we're going to hit those numbers. But I'll be selling most of my miners from 500 to 5,500 is my expectation. And probably 4,800, 4,700 right in there, I'll probably start selling. Maybe at 4,500, but maybe not. But definitely 5,000 to 5,500. Now I'll be exiting, I believe, early, because I think there's a very good chance that gold goes to 6, 7, 8,000. I think there's a very good chance that could happen. But I'm going to miss all that upside. And the reason why I'm going to miss it is because I've been doing this for a long time. I can leave early because I got in early. I've been collecting these things since 2004. Just building my portfolio, waiting for this event, which is about to happen, which is this reset that I've always thought was inevitable. Because again, voodoo economics, you can't live on debt. So it's just a matter of when. So, okay, I'll just wait for it. That's been my philosophy. Buy gold, silver miners, and just wait. And buy quality ones, I've had 20 years to basically figure out which ones to buy. So I've gotten really good at it. That's a long time. But as far as identifying tops, that's really difficult. But what you can do is you can pick a top in advance. That's what I've done. 4,500 to 5,500. So 5,500 is my top. I picked them. You could pick 6,000. You could pick 7,000. Pick a top and then sell to it. That is, I think, a really good strategy. Instead of just waiting until he gets there, I think you should sell along the way.
As the structural cracks in silver supply deepen and price action screams breakout, one force is about to supercharge this entire move: the accelerating collapse of the US dollar. It's not just that the dollar is weakening, it's that its role as the global reserve currency is being openly challenged. And silver, far more than gold, is uniquely positioned to absorb the shock. We're watching in real time as the mechanisms that once upheld dollar supremacy are being dismantled. Nations are striking trade deals in yuan, rubles, and rupees. BRICS nations are openly discussing a commodity-backed settlement system. U.S. sanctions and financial overreach have backfired, driving entire blocks of the world to seek alternatives. The trust is gone, and once trust disappears in a fiat currency, so does its value. This isn't just theory, it's showing up on the charts. The DXY has lost over 15% from its 2022 peak, and the rate of decline is picking up. As confidence erodes, capital is fleeing toward assets that can't be inflated away. Gold is the historical hedge, but silver, with its tighter supply and far smaller market, responds with far greater velocity. It's gold's slingshot. And when fear turns to panic, velocity matters. In a currency collapse, silver doesn't rise in orderly fashion, it surges. We saw it in 1980. We saw it again in 2011. And now, with the debt spiral spinning out of control and the dollar's credibility unraveling, we're poised to see it on a scale that could dwarf both those events combined. Because silver doesn't just protect against inflation, it becomes the currency of last resort. And in a world rapidly abandoning paper promises, the move back to metal is already underway. The only question left is how fast it will happen, and who will be left standing once the dust settles.
So I'm somebody who does this very holistically. So that would be something I'm definitely looking for, right? Like, what are kind of the potential market tops? And so one of the things you want to look at is history, what gold and silver has done historically, and then the charts, the current charts. And so if we look at history, we look at the bottom of the cycle in 1971, 1980, we went from $35 gold to $850. So, 20x. It just gold went absolutely bonkers in that one, right? But that was artificial because we started at $35 gold, which it was kind of misleading. You can't really use that one there. But the next one I think is very valid, which was 2001. We were $250 gold. And we went to 1935, which is about 8x. And I think 8x is probably a pretty good number to use, right? And we went up 8x so far? No, we haven't. So this particular cycle, plus these bull markets generally last about 10 years. Now, some people say that we should use 2016 as the beginning of the bull cycle because that was the bottom. I'm like, no, don't use the bottom. Use the breakout. So the breakout was in 2019. So if you throw 9 on that, it's 2028. So I think 2028 is probably a good year. So 27, I think we're fine. We don't have to really worry about this bull market ending as long as history repeats itself. So those are the historical cycles. The other thing we can look at is the charts. So if you look at the charts will give you a kind of an indicator of how far up it's going to go. The charts actually use the bottoms. It's like use the bottom of a cup and then how far it went down and how far it'll go back up. And so those cycles, people get some really crazy numbers, really, really high levels. Because if you look at the monthly silver chart, that was like the biggest bucket, cup and handle you ever see. So silver, some people use some really crazy numbers of what silver can do based on the technicals. $100 silver, $50. These are just starting points about what silver potentially could do. I'm using $100 silver currently to value my silver miners. I've been using that since 2012. Most people have been making fun of me for years for using that number. Now, guess what? It's too conservative. That's usually what happens. You end up getting too conservative. I think 125 to 150 is a real pretty good target. I think 100 is becoming too conservative. Now, I don't think you should take profits. This is me personally, because I'm a speculator and I don't want to, give away my profits. But as far as I'm concerned, $4,500 gold is easy. So I'm like, I don't see any reason to take any profits till we get to 4,500. Now, if we get to 4,500 and gold is still in this very strong position, like right now with the winds.
The final trigger in this cascade isn't coming from governments or institutions. It's coming from the people. Once the public realizes what's happening, once the panic sets in, the stampede into precious metals will make today's prices look like a forgotten bargain. And that moment is closer than anyone thinks. Historically, silver demand from the public has always lagged institutional buying, until the fear trade kicks in. That's when everything changes. We saw it in 1980, when silver exploded from under $6 to nearly $50 in just months, as inflation ripped through the economy. We saw it again in 2011, when debt downgrades and QE sparked another parabolic move. But this time, the setup is far more explosive. Because unlike the past, we're now facing simultaneous pressure from monetary debasement, industrial shortages, and a collapsing global trust in fiat currencies. When retail investors panic into physical silver, supply disappears almost overnight. Premiums explode, delivery times stretch for weeks, and major dealers run dry. And that's before the mainstream media even starts covering it. Once silver hits new highs and $50 is broken convincingly, The move toward $100, $125, and $150 will feed on itself. Every uptick becomes validation. Every news headline adds fuel to the fire. And remember, we're no longer dealing with a sleepy, niche market. Social media, financial YouTube, and macro influencers have turned silver into a global conversation. When the public panic begins, it won't be slow or rational. It'll be a surge, a tidal wave of demand crashing into a market that simply can't meet it. By the time most investors try to react, the shelves will already be empty. And silver won't be a trade. It'll be a lifeline.
It's fascinating. So the buyers of gold are not Americans and not the U.S. central bank. The buyers of gold is foreign central banks, foreigners. Foreigners are buying the gold. Foreigners are pushing the gold up, not Americans. Americans are buying stocks thinking everything's fine. And the foreigners are going, you guys are screwed. We're buying gold. I mean, that's kind of what the story is. The story is foreigners are basically saying the U.S. is in a big, big problem. And there's no way they can get out of it. And we're going to buy gold because see, what's happened is that we have been on a dollar standard, I think since 1945, right in there. We're on a dollar standard. And so that dollar standard has forced international countries to basically assume U.S. assets, dollars and bonds. So what's been happening is foreigners have been de-risking themselves by selling those dollars and selling those bonds and buying gold. That's what's happening. Central banks are basically, these are all central banks all over the world. They bought 50 tons, I believe, in August. So 50 times ton, that's 600, tons a year. And so they're buying gold and selling their bonds or selling their dollars. When they buy gold, they buy the gold with dollars. And so that's what's happening. It's foreigners recognizing Triffin's dilemma and getting away from these U.S. assets, recognizing that there's a transition coming. I don't want those stinking dollars anymore. I don't want those stinking U.S. bonds anymore. I want gold instead. They're basically front-running the crash, if you will. The U.S. consumer, the average U.S. consumer doesn't own any gold. I think the average one has less than 1% of their net wealth in gold. It's less than 1%. It's tiny, tiny, tiny. And that's the average. So maybe most people have zero gold, don't have any, right? And the average is less than 1%. And so it's really foreigners that are pushing the gold price up, not Americans. But that'll change. That's when the fear trade comes in. And then when the fear trade comes in, then the Americans will start buying gold. They haven't started yet, but that's coming. We're seeing a lot of people say things that we've never heard them say before as far around gold. We're seeing some banks basically saying, look, you need to have, we've basically saw somebody say 60-20-20, where you need 60% stocks, 20% in bonds, 20% gold. 20%. I never thought I'd ever hear a bank recommend that their clients have 20% in gold. Are you kidding me? The average American's like, 20% in gold? Are you out of your mind? It's like, no way in hell I'm going to do 20% in gold. That's the mentality in America today. It'll change. They're basically just giving everybody a heads up. You might think about 20% in gold. That's what Triffin's dilemma is kind of pushing us toward. Is pushing us toward accumulating gold and silver as people become more recognized. Because the end game here is a reset. And the reset is going to be a devaluing of the dollar. That's the reset. And if we devalue the dollar, guess who wins? Gold. That's how you front run the reset. You buy gold. You protect yourself. You protect your capital. That's what gold's about. Gold isn't about making money, except for in the mining stocks. Gold is all about capital appreciation.
The silence before the storm is already over. Now we're in the opening act of the greatest monetary upheaval in modern history. Foreign central banks are exiting treasuries, the dollar is unraveling, and the public is still asleep at the wheel. But the smart money isn't waiting for a headline. They're preparing for a reality where silver is no longer just a metal, but a monetary anchor in a world without fiat trust. Silver's path to $150 isn't just possible, it's logical. The debt trap is tightening, the supply is collapsing, and industrial demand is rocketing to all-time highs. The breakout above $48 wasn't noise, it was a signal. And what comes next is not a correction, it's a revaluation, one that could shake the foundations of the global financial system. So the question isn't whether silver will hit $150. The real question is, will you be holding it when it does? Subscribe to stay ahead of the curve and stay informed as this once-in-a-generation reset unfolds. And remember, this is not financial advice. Always speak with a licensed professional before making investment decisions.